Tesla hitting around 360,000 deliveries this quarter might actually be bad news. Hey everyone, Ken here. In today's video, I'm going to break down what Wall Street is really expecting for Tesla's Q1 deliveries, why some analysts believe even this number could be too optimistic, and most importantly, what this actually means for Tesla stock going forward. Because if you only look at the headline number, you might completely misread what's really happening. Let's start with the surface level view. Right now, the consensus for Tesla's Q1 2026 deliveries is around 360 to 365,000 vehicles. On paper, that looks like growth year over year. And for many investors, that's enough to say Tesla is still strong. But this is exactly where most people stop their analysis. And honestly, that's the mistake. Because when you zoom out just a little bit, the picture changes. Compared to Q4, Tesla is expected to be down roughly 12 to 13%. Now, yes, Q1 is usually a weaker quarter due to seasonality. That's normal. But even after accounting for that, this drop is larger than what we would typically expect. So the question becomes, is this just seasonality or is something else starting to show up? Now, here's where it gets even more interesting. That year-over-year growth number, it may not actually represent real growth. If you remember, Q1 of last year was unusually weak. That was during the transition period with the Model Y refresh, which temporarily impacted deliveries. So what we're seeing now could simply be a rebound from a low base, not a sign of strong forward momentum. And this is a critical point, because if you misinterpret recovery as growth, you end up overestimating the strength of the business. Now let's talk about what analysts are actually saying. Not everyone is aligned around that 360,000 number. In fact, some analysts are modeling much lower. We're seeing estimates in the 340,000 range, and in some cases, even below 350,000. And this is important, not just because of the numbers themselves, but because of what it represents. When you start seeing a meaningful split in expectations, that tells you the market is uncertain. And more importantly, it suggests that the consensus itself might be leaning slightly optimistic. So why is there such a gap in expectations? There are a few key reasons. First, EV demand is no longer in that hyper-growth phase we saw a few years ago. Globally, the market is starting to normalize. Growth is still there, but it's slowing. At the same time, price competition is increasing. Tesla used to operate in a market where demand was almost guaranteed. That's no longer the case. Second, competition is intensifying, especially in China. Companies like BYD are expanding aggressively, offering competitive pricing and strong product lineups. And as consumers are given more options, Tesla's dominance becomes less absolute. This doesn't mean Tesla is losing, but it does mean the environment is more competitive than before. Third, and this ties back to what we discussed earlier, is the comparison effect. Because last year's Q1 was weak, this year's growth can look stronger than it really is. Some analysts are adjusting for this, others are not. And that's creating a divergence in expectations. Now, everything we've talked about so far is still within the numbers framework. But here's where I think the real story begins. Because in my view, the most important takeaway from this situation is not the delivery number itself, it's what it represents. And what it represents is a shift. For a long time, Tesla has been valued primarily as an EV company. Deliveries went up, the stock went up, that was the model. But that model is starting to break. Take Tesla's energy business, for example. Products like Megapack are seeing strong growth, and this segment is often described as having higher margins and more stability compared to the automotive side. This is not just a side business anymore, it's becoming a core pillar. And then there's AI. With full self-driving and eventually Robotaxi, Tesla is pushing into an entirely different domain. If successful, this could fundamentally change the company's revenue model. So when we talk about Tesla today, we're really talking about a company that is evolving beyond cars. And this leads to a very important point. The metrics we've been using to evaluate Tesla may no longer be sufficient. In the past, deliveries were everything. Now, you have to consider energy growth, AI progress, autonomy timelines. These are the factors that could define Tesla's future valuation. So when you see a number like 360,000 deliveries, it's not that it doesn't matter, it's that it doesn't tell the whole story anymore. In fact, you could argue that focusing too much on this number might cause you to miss the bigger picture, because what this number is really signaling is two things happening at the same time. EV growth is slowing down, and new business pillars are starting to emerge. So let's bring this all together. There are three key takeaways here. First, the 360,000 delivery estimate might look like growth, but underneath the surface, it could be weaker than it appears. Second, the fact that some analysts are projecting significantly lower numbers suggests that the consensus itself may be too optimistic. And third, and most importantly, Tesla is undergoing a structural transformation. It's shifting from an EV-focused company to something much broader: energy, AI, autonomy. These are not side stories. These are becoming central to Tesla's identity. So as investors, the real question is not just, did Tesla hit the delivery number? The real question is, what kind of company is Tesla becoming? Now, before we wrap up, let's quickly touch on the stock. Tesla is currently trading around the $360 level after dropping below the $370 support. And this decline is happening alongside a broader market pullback with all three major US indices down. So this isn't just Tesla specific, but still the weakness is noticeable. We'll do a deeper chart analysis in the next update, so make sure to stay tuned for that. Alright, that's it for today. If you found this analysis helpful, make sure to like the video. I post daily updates covering Tesla from both a strategic and investment perspective, so if you want to stay ahead of the curve, consider subscribing. Thanks for watching, and as always, let's keep thinking long term. Before we wrap up, let me take a moment to introduce myself. I drive a Tesla Model Y, and at home, I've installed a Tesla Powerwall, so I actually charge my car with solar energy. I truly believe Tesla is shaping the future, and that's why I share the latest news and insights here on this channel. I'm from Japan, but I want to connect with Tesla fans all around the world. That's why I also create an English version of my videos. YouTube now lets you switch the audio into your own language, so you can enjoy it in whatever language you prefer. Most of all, I'd love to connect with Tesla fans everywhere so we can support Tesla together. I also share updates on X, so feel free to follow me there and let's connect. And if you haven't already, please subscribe to this channel. I'd really appreciate it. Thanks for watching, and I'll see you in the next video.